Hey, everybody.
Well, welcome to this month's Bob Benny Wealth Management monthly webinar. The title of this webinar today is how to optimize your 401k. And when we're talking 401ks, it's about any kind of employer-sponsored retirement plan at work.
So the way that you can ask questions as we're going through things, if you think of any questions, you can type in the chat box in the bottom of the screen and we'll address all of the questions at the end.
So
we're going to go ahead and get started, but the three main things that we're going to talk about today are first, how to choose the investments within your 401k. Second off, how much you should be contributing to your 401k and what the maximum contribution limits are for this year. And thirdly, what you can do with your 401k either at retirement or before retirement.
So on the topic, how to choose the investments within your employer-sponsored retirement plan. Before I start talking about that, right now, today, what's the biggest financial threat to you and me, Jessie, and all Americans, frankly, all the people around the world?
I think inflation.
Not just inflation, but what I call hyperinflation, just extraordinarily high inflation. People know it when they go buy groceries, go buy gas, everything's going up, and it's just going to get worse. And so in light of that's the biggest financial threat to all Americans, there are three places that you should not have money and three types of investments that people should have money. And I want to go through that. So when there's a threat of high inflation, the three areas you don't want to have your money in are cash, which would be savings and checking and money market and cash in your piggy bank, CDs, and bonds. None of these investments will keep you ahead of or even with inflation. Particularly bonds are bad, or bond funds. If that's inside your employer-sponsored retirement plan, you don't want to have any bond funds, because as interest rates go up, and they are and will continue to go up, as interest rates go up, Jessie, bond market values go down. So don't want to have money in cash, CDs, or bonds. Obviously, people need to keep a little bit of money in cash in the bank for a rainy day, 2, 3, 4 months living expenses. But we're talking about employer-sponsored retirement plan. So the three areas that you want to have money when there's high inflation or expectations of even higher inflation, and there are, is if you think about what inflation is, it's the rising cost of goods and services. Does that make sense? The rising cost of goods and services. So I think the best place, and historically one of the best places to have money in times of high inflation, are companies. Companies, because they produce the goods and services whose prices are going up. Second is real estate, like your home, or income producing real estate like a rental house or a farmland. And finally, gold. And I don't like gold as much as the other two because gold doesn't produce anything, doesn't produce any rent, and it doesn't produce a good or service that's going up in times of inflation. So we want to be in the stock market in the employer-sponsored retirement plans.
So the options that you typically have in your employer-sponsored retirement plans are usually going to be mutual funds. And what a mutual fund is basically it's a basket of stocks or bonds. And we're going to talk a little bit about kind of what to be looking for in the funds that you're invested in and how to pick those. So first off, there's index funds and there's managed mutual funds. And so the difference between those two things, an index fund, so we're talking about a basket of stocks or bonds. Basically, you're buying a basket of the stocks that are in whatever index that fund is tracking. So for example, the S&P 500, right, which is the largest 500 stocks on the New York Stock Exchange. There's a whole bunch of different indexes that track kind of different sections of the stock market. But you're buying and holding all of the funds, all of the stocks in that index.
They're not buying in an index fund. They're not buying and selling, trying to pick winners and losers amongst those stocks. They're just buying them and holding them.
And then on the other side of the spectrum, you have managed mutual funds. And in those mutual funds, they are competing with an index and they're trying to beat an index. So you have a manager that's being paid to manage those funds that's buying and selling the holdings inside of that fund to try to beat the index. Now, historically, index funds have historically almost always beaten out those managed funds, even though the managed funds are trying to beat the index.
Yeah.
So in 2021, for example, 80% of actively managed mutual funds underperform the index that they're compared with.
So our philosophy is why try to choose a mutual fund manager that's going to beat the index when most of the time they can't beat the index anyway. If you buy an index, what this also means, if you buy an index, Jesse, you beat 80% of the managed mutual funds. So we'll just buy the indexes.
This is a quick pie chart that shows how a whole bunch of different active mutual funds have performed against their comparative benchmark, which means their comparative index, the closest index to what the mutual fund is. And the yellow amount is the amount that have underperformed the index that they're compared to. So as you can see, and this goes out, so I told you last year in 2021, 80% of actively managed mutual funds underperformed their index. So if you go back historically further, so this is the last 20 years, it gets even worse. Some of these haven't outperformed their index, you know, even 1% of the time for like the large cap growth funds.
Yeah, in the upper left-hand corner there, all domestic funds, that's all United States mutual funds. Less than 95% of, or more than 95% of them underperform the index. So anyway, that's the reason we choose indexes.
Yeah, only 5%, saying it a different way, only 5% of actively managed mutual funds were able to beat their index. Another advantage of index funds is, since you don't have an active manager, the internal fees inside of them are a lot less than what the internal fee inside is for a managed fund, since they have to hire a manager and be actively buying and selling the holdings inside of that fund.
What's the average expenses for a managed fund?
It's about 1.4%, and the average for they call it a passive fund, but for an index fund is 0.2%.
Yeah, so 0.2.
Paying a lot less.
So then you want to look in the 401k for hopefully stock index type funds rather than managed funds. Another thing is a choice between domestic or United States versus foreign stock funds. And right now, just as I told you, the best places to have money of the three in stocks or in companies, we also want to make a choice between domestic and foreign, and you're safer, I believe, right now in domestic mutual funds or domestic stocks than you are in foreign stocks. And it's simply just my belief, and it's born true, that if you think about what the stock market is, it's about capitalism, right? And is capitalism expanding or contracting outside the US right now? Right now, it's not expanding, it's contracting. So you're better off in domestic funds. And then you have a choice between large companies, they call them large cap, capitalization means the size of the company, mid cap and small cap. And we're safer right now in the large cap, large companies, than in the mid cap or the small cap. So I'd recommend that you have probably 80% or more in large index funds in your 401k, and no more than 20% in the mid cap and the small cap. And then there's kind of an investment snot style box that Morningstar uses, and we'll show you something about Morningstar in a minute. And it categorizes funds or companies in small, mid, and large size along the vertical axis there, or vertical part, and then horizontally between value, blend, and growth. Blend is simply a combination of growth and value. Growth are generally younger companies, not super young, like 1 or 2 years, but companies that are plowing most of their profits back into the company. versus value or more established older companies that are paying out some dividends. I recommend you split it either half and half, half between growth and half between value, or maybe weighted a little bit towards growth at this time, given the where we are in the economy and the markets. And then you also have target funds. And oftentimes those will be options within your 401k. A target fund, you always know it's a target fund, first off, if it says target in the name of the fund. That's an easy, but if they have a year in there, like 2030 or 2035 or 2040, and the general idea when they established these was, if you're going to retire in 2035, for instance, you should have your money in a target 2035 fund. But we're recommending totally avoiding those funds right now. And you want to tell them why?
Yeah, we'll show you why. And we want to introduce you to a tool that you can actually use yourself to look at the funds that are available inside your 401k, or the ones that you are currently invested in now. And since we talked about that mutual fund is a basket of investments, it's good to know what the investments are inside that basket, basically, that you're in. And so this tool, Morningstar, is a website that anybody can use. And we're going to show you it here. It's just morningstar.com. And what you can do is you can look at the options inside your 401k, and you can search in this search box the ticker of whatever mutual fund that you're invested in or looking at, or the name of it. And we're not going to pick on any particular target fund, but I did look up a particular target fund, and I blocked out the name of it so that we don't pick on it. Yeah. But I want to show you kind of what to look for.
There it is.
All right, so if you look up your particular fund that you're in, and you go to the portfolio tab, you can see exactly what it's invested in. And so this particular fund is a 2030 target fund. And what it's actually invested in is 40% US stocks. The non-US equity is international stocks. And so 25% of it is in international, which we don't want right now, as we talked about earlier.
It's alarming. When I started looking these up, Jesse, and for people that would come in and have me help with a 401k, it's alarming that in these so-called sort of conservative target funds, that they have 25% of the money in non-US stocks. Even in a good situation where I didn't believe that capitalism was contracting outside the United States, that's way too much money to have in foreign stocks. So,
and then the fixed income part of it, what fixed income means is they're talking about bonds. So they have 33% of this account invested in bonds, which is another thing that we don't want right now, since interest rates are on the rise.
Anybody that owns bonds or bond funds or target funds they're taking a big risk, because they're essentially saying, I don't think interest rates are going to go up. Well, interest rates have gone up and are going to keep going up, because that's the government's only tool, really, to try to fight inflation. And so you're going to lose money in bonds if interest rates go up.
All right. So moving on to our next point of how much you should be contributing to your 401k. Do you want to talk a little bit about that and about employer match?
Sure. The first thing you should do is make sure, everybody should do that has a 401k, is at least put in the amount of money. If they have a matching provision in the 401k, at least put in the amount of money that your employer will match, because that's free money. Sometimes it's dollar for dollar. Sometimes it's 50 cents on the dollar, say for up to 5% of your income that you can sign up for to take out of your check before taxes are taken out to go into the 401k. Maybe they're going to give you 50 cents on the dollar. So nowhere else are you going to invest money, like at a bank or with us or any other financial place in the world, are they going to instantly give you 50 cents on the dollar or anything on the dollar for just investing with them? So that's a given. You have to start off with at least the match, or at least get to as quick as you can the amount that they will, the maximum amount that they will match. And then you're allowed to put away more. And so kind of a general rule of thumb that I tell people is, if you can save, you know, starting relatively early in your working career, in your 20s or even early 30s, if you can save 10% of your income and out of your check and put it in your employer sponsored retirement plan, by the time, as long as it's invested smartly, by the time you retire, you're gonna have plenty of money to retire on. You're gonna be relatively wealthy, probably be able to, I would expect, be able to live under the same you know, standard of living. That's the word I'm looking for. Thank you. Live in the same standard of living as what you were while you were working. So try to go for at least 10%. Now, if you're starting late, like in your mid 50s or 60 or something like that, 10% is not going to be enough. You want to plow a lot of money in there, but 10% is the general rule.
Now, you are limited on the amount of money that you can contribute every year. And so the amount actually went up for 2022. And that amount right now, I'm going to share here on the screen, is $20,500. And so if you're 50 or above, you can actually contribute an extra $6,500. So you can contribute $27,000 to your 401k. And something that I think people get a little bit mixed up is a 401k and an IRA. And those are two separate things. So an IRA has a contribution limit of $6,000 for the year. And if you're 50 or above, it's $7,000. So it's a lot less, which makes your contribution to your 401k extra important, because you can contribute so much more money to it.
Right.
And the difference is your 401k is obviously your work retirement plan, and somebody else is helping contribute to that as well, your employer, while your IRA is more your personal retirement plan.
Right. And then many 401ks now also offer a Roth 401k. And the difference between a traditional 401k and a Roth 401k is the same as the difference between a traditional IRA and a Roth IRA. So it's kind of money that goes in a traditional 401k or traditional employer sponsored retirement plan or a traditional IRA, you get a tax break on it. It comes out of your check. If it's in your employer sponsored plan, it comes out of your check before any taxes are paid on it. It grows tax-free or tax deferred until you retire and start taking money out, and then you got to pay taxes on it. In a Roth IRA or a Roth 401k, that money, you've already paid taxes on it, but it grows tax-free. And tax-free for as long as you live, and it goes tax-free to your beneficiaries if they inherit it. So if they have a 401k option or a Roth option in your employer-sponsored retirement plan, it could be real beneficial to have money both in traditional and in Roth, because it'd be nice at retirement, especially if income tax rates go up, to be able to take some, while the rates are up, to be able to take some of your retirement income out tax-free. It's going to depend on everybody's situation, though, whether the Roth contribution is better than the traditional contribution based on what kind of income they have now and what kind of income they're expecting in retirement. So that's certainly something that we can answer for you. And by the way, as we're talking about this, anybody that's on this webinar or anybody that you know that's a friend or a relative that has a 401k that needs some help with it, because a lot of people don't get any help with their 401ks, we're glad to help you. We don't charge anything for that. I've been doing this for 27 years now, and I've been helping people with their 401ks all along, and we don't charge for it. And you know, my philosophy is, if I help people with their 401ks and they do real good with them, sometime maybe when they retire, they might want to roll it over to us. But anyway.
So that moves us on to what your options are with your 401k, particularly at retirement. But typically people have three options with their 401k. The first option is they can roll it over to their personal IRA. The second option is they can leave it in their 401k plan, invest it as it is, and just when it's time to take money out of there, they'll just take it straight out of the 401k. Or third, they can annuitize it, or some people will call this like a pension option.
Pension, right.
Which basically means you are going to give the lump sum of your 401k money to the 401k company, and then they're going to pay you out guaranteed monthly payments for either as long as you live or an amount of time that you agree upon with them.
We'll talk more about that in a minute.
Yep, and we're going to talk about each of those in detail a little bit, starting with rolling over to your IRA.
So oftentimes, most often, when people retire, at retirement, they roll over their employer-sponsored retirement plan, their 401k or 403b or whatever it is, to their own IRA. Many plans now also allow people to, while they're still working, once they reach age 59 and a half, to roll it over into their own IRA. When that happens, there's no tax. It just goes from one tax shelter to another tax shelter. The reason that oftentimes people want to do that, one is to get professional advice from somebody like me or Jessie, and on their investments and withdrawals and all that sort of stuff, but also because they have more and oftentimes better investment options than are in the employer-sponsored retirement plan, which are always limited to maybe sometimes 5 or 10 or 20 different options. And so the other real key thing about once somebody's retired, taking money out of their own IRA for retirement, let's say that you have an IRA and you're retiring at age 65 or 67, and we figure out what you're going to get for Social Security and stuff, and you need, a couple $1,000s a month to supplement the Social Security, or 3 or 4, whatever it is. You get to choose, if it's your own IRA, what amount of taxes are withheld from that distribution. It's, maybe, it's not that much, and so you're not going to have any taxes withheld, or maybe you're going to have 10% federal and 5% state and so forth like that. The second option what to happen at retirement, leaving your money in the 401k or in the employer-sponsored retirement plan, it's mandatory that there's a 20% federal income tax withholding. And that's probably more money than you're going to need to withhold. So an advantage of having your own IRA is you get to choose how much, and ideally you want to fit however much withholding there is to however much you're going to owe in taxes, so that you're not letting the government have your money for a whole year or whatever before you file your tax return. And of course, leaving money in your 401k, you're stuck with those investment options that are there, which sometimes are not that great, and you don't have a professional financial advisor helping you and guiding you along the way.
Right. Then the last option is the annuitization option. And I think that option makes a lot of people feel comfortable right off the bat because of the guaranteed income in retirement that it provides. But can you talk a little bit more about why that's maybe not the best way to get guaranteed income?
Well, in most cases, when people have that pension or annuitization or whatever they call it, option that I've evaluated for them, usually the option ends up paying them. You can just simply take, okay, well, they'll pay you whatever, $2,000 a month for the rest of your life. Anyway, you multiply that times 12 months, 24,000, divided into the lump sum that they would get if they didn't take the pension or the annuitization option. And it ends up that usually they're getting paid maybe 9%. And what it means is that you're going to get that money every month for the rest of your life, but when you die, they get to keep your money. And it doesn't work out.
There's nothing left.
There's nothing left. Now they'll have some other different kind of options, but the one where you get the highest percentage is that your life only option. But that's also something that we can always evaluate for people for free to help you make the best decision for you, whether it's an annuitization option or leave it in the 401k or roll it over to your own IRA.
Absolutely. So we're gonna wrap things up here now. We're gonna answer any questions if anybody has any. It looks like we're about right on time, 25 minutes. Good job.
Do we have any questions, Jess?
We don't have any questions right now, but if you think of any after we get done with this, feel free to shoot either of us an email or give us a call at the office. My email is just jessie@bobbenny.com and his is bob@bobbenny.com.
Yeah.
Go ahead.
I was just gonna say, anybody that has a question on their employer-sponsored retirement plan, whether it's with the city of Lincoln or the state of Nebraska, or at work as a school teacher, or working for a company or whatever like that, we're here to help, and we like to help people. And so we won't charge anybody anything to help them, and we will help them figure out how to allocate the money in their 401k for their best interest and for their best retirement.
Absolutely. Thank you guys very much for your time and for being on this with us. We appreciate you.
Thank you.
Have a great week.